London and Toronto listed Canadian Overseas Petroleum has recently acquired producing assets in the United States. The company says that this starts a new chapter and transforms its value proposition to investors. Arthur Millholland is chief executive of the company and owns a 3% stake in the business. Arthur, good to talk to you. Thanks indeed for your time. I was talking there about the US assets, but in the portfolio, of course, you also have interests in Nigeria. Should we regard the US assets as the new big thing? Is this what's taking up most of your time?
It certainly is, and it's a great asset, and why we're there is that the U.S. traditionally is probably the most difficult place to enter at a low cost. It's one of the economically, the fiscal terms in the United States between taxes and royalties are some of the best in the world, and it's a low risk jurisdiction, and so we did it at an opportune time. We negotiated the acquisition this time last year when oil prices were at $39. Today, West Texas Intermediate is 82. And the other side of it is that this is basically a brand new oil field.
And my understanding is that recent readings indicate that, in fact, it is actually could potentially produce more or produce better than expected returns. Is that right?
And that's correct. Is that it went into what we would call an enhanced recovery operation right away, which is a miscible flood where we expect to recover in excess of 50% of the oil in place rather than 5% if you did nothing. And so we completed the acquisition in the middle of March and went right away to an aggressive injection of natural gas and butane together, which is the solvent, to drive the production up. So the production, when we started at the 1st of April, was at 1,200 barrels a day. It hit a peak around 2,700 in August. Our injection volumes have come down just because we've had to, the plant that we're buying them from had a turnaround, and so we had difficulty accessing volumes of butane, which is just starting to come back on here. But interestingly enough, is we're seeing a really correlatable response to injection volumes and pressures, and which we're resimulating the reservoir here right now. So as time goes on, we expect the production by this time next year to be substantially higher, and as I say, it would never have been for sale if it wasn't for the circumstances last year.
Just want to bring up a share price chart because I think this is interesting in the context of something else I was going to talk about. Because despite this this transformation, you're on record as saying that you accept the market remains cautious, and I think this is highlighted by the direction of the share price. Just explain why you think there is this cautiousness around what it is you're trying to do.
Well, in some respects, we're somewhat perplexed by it as well. I think that the way the markets are here today is that the stock will take care of itself as the production continues to grow. We've drilled a well actually below the field and made a discovery, which we're in the process of evaluating. It's been delayed primarily due to supply chain issues, lack of truck drivers. Services are tight in their availability, but it's progressing along. So things are outside of our control. So I think in the short term was that, the market took the impression of no news is bad news. And, we, like all public companies, we can't give a press release every other week as a play-by-play. But our third quarter, we report quarterly as we're a Canadian reporting issuer. We have to. So our third quarter results will be out on November the 15th. And, by that time here, we should have the evaluation of this well completed, and hopefully, and we'll update the market accordingly.
How are you dealing with this point about truck drivers? I mean, I've spoken to a lot of chief executives over the last few months, and they're all saying the same thing. It's supply chain issues. It's the fact you can't get the staff to do what it is you want to do. In some cases, of course, it's a technology-driven issue that you can't get the right staff in the right place. What are you doing about that to ensure that you do have the right staff in the right place?
Yeah, that's actually a very good question. The issues, believe it or not, in the United States and Canada are really not much different than what you're experiencing over here. And I've been here in the UK, throughout COVID. I'm about to go home here shortly. But the key issues, if I sit back and look at it and talk to our people in our office in Denver and of course read the press, is that the lockdowns that people went through globally, really unsettled an awful lot of things, and governments around the world paid, we'll call people, in the case of here, supplemented their incomes. They certainly did in the United States. And in the case of the oil and gas industry, in April of 2020 in the U.S., oil prices went negative for a day. And so the dramatic drop in oil prices caused a real retraction in the industry, and especially in the oil field service industry, where people got laid off in a massive way. And a lot of those people left the industry and just not to come back. So in the case of truck drivers, they were short to begin with. And then, of course, then you need field hands to operate the equipment, whether it's cementing equipment or down, things that you run down the hole. And so they're short of staff. And as well, through the year, because the companies themselves were short of money, they deferred a lot of maintenance on their equipment. And some service companies, in the case where we are in Wyoming, left the area altogether and retrenched in other places such as the Permian Basin or in North Dakota. So the services are there, but we find we have to get in line. And some of the operations that we do, there's just not one piece of equipment out there. You need sometimes 3 or 4 different things to conduct your operation. And if one of them doesn't show up for some reason, then you have to reschedule and push everything back and get back in line again. And so it's been a common issue, but we do see things talking to our engineers, talking to service companies, and saying, look, we're going to be here for a while, and this is what we need, and you need to bring it back into the basin, and it's starting to work, but it's an issue that people are facing. In Texas, for example, the truck driver shortage in the oil field is so short that they're offering truck drivers $14,000.
Yeah, well, this was I think leading up to my point. It's the fact that this is the problem, isn't it? That you end up having to pay more money for these guys if indeed they're around at all. But I guess we'll hear more about that when you produce numbers in mid-November. Just talking about the numbers, I'm hoping you can answer this question. We're not too close, maybe, to the figures in mid-November. What are the financial fundamentals like? Bearing in mind what you're trying to do with this operation in the States, clearly it's costing money. Have you got the money to support what it is you're doing for the time being, at least?
Yes, we certainly do. And we borrowed money to buy the business, $45 million last year, or this year, and earlier this year, and as well we raised in between late 2020 and 2021 $30 million of equity in the London markets to finance the acquisition, which was $50 million in cash and $4 million in stock. The key thing is that on our loan, like any lender, requires you to hedge a certain amount of your oil production, and because we don't have a declining production curve, we've got actually an inclining curve, which makes it very difficult for us to forecast the future until things settle down, and they haven't settled down yet. But that being said, is we agreed on a we'll call a conservative curve to hedge, and a portion of production is hedged at $61. Now, when I get some communication from people, they say, shareholders, they say, oh, well, oil's at 82, and a portion of your production is hedged at $61, so that could be a reason. what people also don't understand, and because they frankly don't read our reporting, is that we also hedged our purchases of butane. And to give you an idea, we've since April the 1st, we've injected, as of late last week, 1.4 billion cubic feet of natural gas and butane at a 60-40 ratio. Now, butane prices in March or late March, when we hedged our purchases, were 91 cents a gallon, and this year we hedged purchases of 1 million gallons a month, slightly under that actually, but close enough to be 1 million gallons a month. Current prices of butane are $1.60 a gallon. And so when in fact is that they've risen by more than 50%, and so much higher inflation than oil prices have risen. So we're actually making money on our hedges. So either on one side, we've got, our swaps on crude oil, are under what oil prices are, but our swaps on butane purchases are way positive. And then starting in January on butane, it goes down to 76 cents a gallon. And right now, butane and propane prices are very high in North America. And why? Because the Chinese are buying basically everything they can get their hands on. So the stocks in the country are below what's the historic norms. Natural gas prices in North America increased dramatically. We didn't hedge our natural gas purchases because, frankly, our hedging advisors and people were all shocked at what the prices of natural gas got up to in August, September. They've come off a bit, but we see butane prices staying high.
I think it's interesting, isn't it? I'd like to find out more about what it is you're using all this gas for, because this leads neatly as well into this ESG thing, doesn't it? And what the company's doing, your operations, how you operate, and what your carbon footprint's like. What do you say to people about that? I mean, we're talking now just ahead of the COP26 meeting in Glasgow, when everybody's going to be talking about ways in which we can reduce our carbon footprint.
Yeah, I think that the first thing that we have to understand, I've been in this oil business for 38 years, and we're 39 next year. And the key thing is that the oil industry, in some respects, can be its own worst enemy. And depending on where you go in the world, you can see big messes, or you can see things that are done properly. In the case of this field, it's new, and by its nature, because it lacked a drive, that the previous owner designed it to essentially put an artificial drive in the reservoir to enhance the recovery of the oil from the reservoir. And so if it left to its own devices, you would have recovered 5% of the oil in place in the reservoir, and we should easily recover 50% or more over time of the oil in place in the reservoir. So to do that, you inject natural gas and butane. And what the butane acts as a solvent. So in essence, the gas pressurizes the reservoir as the carrier, and butane, you essentially are stripping the oil out of the reservoir. But as you produce the oil, you'll recover associated gas as well as a portion of your injected gas. So we don't flare any gas, zero. And so any gas, all the natural gas and liquids that are recovered on the producing wells are separated and go back to our gas plant, are recompressed and injected back into the reservoir. And the pressures at surface discharge pressures of this gas plant are 4,000 pounds per square inch. So there is zero gas flaring. The next thing is in the ESG discussions around the oil and gas business are methane leaks. Now, methane is a much more potent greenhouse gas than CO2. And normally in the past, you would see in certain countries, if you go to the Middle East, they flare an awful lot of gas and they just vent it. and that's just bad. Now, in our case, we have to monitor our methane leaks. And the reason being is, especially on the injection side, because the pressures are so high, is that frankly, we don't want to have an explosion. So, 4,000 pounds per square inch is awfully difficult to get your head around, considering when you fill your tires up on your car, you put 30 pounds or 32 PSI in them. So we, by design, we operate efficiently. And the next thing is, in this part of Wyoming, it's called the Powder River Basin. It's 20 miles from Casper, Wyoming. There aren't any trees. Why? Because it's dry and the wind blows all the time. So there's a very large wind farm right adjacent to our lands. And everything's electrically driven, from the motors that run the wells that are pumping to the compressors in the gas plant. And all of our electricity comes off that wind farm. So is to turn around and say, yes, the industry can do it. There's, because it's an investment to do it. Yeah. We get a tax credit in the United States, which is normal for the enhanced oil recovery. But believe it or not, it's actually makes the whole operation much more efficient, and cost wise, it's not any higher than if you didn't do it.
Just want to very quickly go back, if I can, to how you're funding all this. Are you going to be pumping enough oil to be self-funding, or are you going to have to come back to the market? What's your situation?
No, we don't have to come back to the market. We're self-funding. Our cash flows. Initially on the gas injection, we were putting more hydrocarbon into the reservoir than we were getting out. And we're beyond that now. So in effect, the business is operating, and as the positively, and as the production increases, the cost, we'll call our makeup gas, our purchase volumes of methane and butane won't go any higher than they are now. And in fact they'll come off a little bit as everything gets in the reservoir, gets into balance, which we're not far off. So as the production shoots up, is that our netbacks on per barrel will continue to rise. And so our overall operating costs will come down, and, depending on prices of our input costs, because they're variable, hopefully they should settle down around $10 a barrel, right? This time next year.
Okay,
very profitable.
Music to an investor's ear. Let me just quickly ask you again in the context of share price. We showed a short while ago. What's been priced in then at these current levels, bearing in mind what you're talking about and the advantages you have in doing it where you're doing it, and the cost advantage of the fact you're getting production out? What's being priced in?
Well, that's the 64-pound question, isn't it? We certainly look at it, scratch our heads a little bit, but I think there's a couple of reasons why what's priced in the share price. First, up until we did the placings here late last year and earlier this year, which were all institutional, family office type of investors, and not through private client brokers that were called retail. We had a very large retail shareholding base in the company, and then we had one of the most liquid stocks in the London Stock Exchange. Now, in North America, this transaction we did would not have been considered to be a reverse takeover, but here in the FCA rules, it was, considering the asset size. There was no change of control in the business or anything like that. So we had to file a prospectus, which we did in August, but more importantly, we had to produce 3 years of audited financial statements on the business that we acquired. The difficulty in doing that was because it was a structure unique to the United States called an S Corp, which is a flow-through tax structure. It didn't have any shareholders. That had a member, being one individual. So in other words, he personally took all the tax benefits of the company, the liabilities as well. And the accounting standards that an S Corp has done is to the standards of the Internal Revenue Service, not international financial reporting standards. So we essentially had to go back 3 years and start from scratch, and that took time. So by the time we came off the suspension, we lost momentum in the market. And I believe that was an awful lot of things. And the second thing is that sitting back and looking at it and talking to people in the market, I also think that we're seeing a lot of effects of what's going on here right now, we'll call with the retail investor, because our institutional investors right now, we've spoken to them, are predominantly, they're investors, they're holders. A lot of retail investors who likely be watching this in their interview some of them are traders, some of them are investors.
Yeah.
And the difference is an investor will hold it long term, a trader will hold on short term. And because of our liquidity, now we consolidated the stock 100 to 1 and went from 16 billion shares outstanding to 160 million. That hasn't changed our liquidity at all. When we look at it on our daily volumes, our average weekly volumes, on a proportionate basis, they're still the same. But I think what has changed is that a lot of people, the government packages were on, we'll call the COVID relief packages were on, and that put money into people's pockets. It certainly was a case in the United States where things are well documented. But on the other side there's an awful lot of inflation going on here, and it's starting to hit home. If you've gone to the grocery store and look at what just costs you to buy your weekly grocery bill has gone up dramatically. I certainly see it. Their natural gas bill to heat the house. Natural gas prices here in the UK and Europe are 7 times of what they are in North America.
Yeah.
And so that hits people's pocketbooks, as we say.
Yeah.
And so if you're, we'll call a punter, no different than, putting a $5 on a horse race, is I believe that's taking money out of people's hands.
Yeah.
And that's certainly the impression I get when we talk to people in the market. Now, the other thing is that just remember, when stocks are traded and if there's a seller, there's also has to be a buyer on the other side. That's what makes the market work. And if there's sellers, and of course the buyer wants to buy low and sell high, and so we did have some sellers in our stock here in August and early September. One, family office that we understand may have had a margin call. So when individuals have margin calls, sometimes you don't want to sell, but you have to sell.
Yeah. Yeah. Let me just sort of ask a couple of final questions. We've spoken a lot about the US assets. We've got to talk very briefly about Nigeria. How important is that to you, bearing in mind the importance of this US asset that you brought on to the company?
The asset that we have in Nigeria is offshore, and we've done an awful lot of work on it over the years, and it's very attractive. We've had an ongoing issue with one of our partners, essentially the group that we acquired it from, which is SR, and that in our mind has just slowed everything down. In conjunction with that, the government of Nigeria finally passed a new petroleum law, and so there's discussions ongoing with SR, to comply with that. But right now, it's there. And there's an awful lot of other things in Nigeria that, let's just say, it's easy to find oil in Nigeria. That's not the issue. The issue is with whether it's the politics or the way business is conducted.
Are you interested in keeping the Nigerian asset, bearing in mind what you've just said?
In the long term, yes. And the reason being is that if you look at the world today, and oil prices have gone up dramatically, there has been globally, with exception in the United States and say Canada, onshore, there has been a lack of investment in the oil and gas business for the last 10 years or longer, and since the last financial crash. And we're seeing that today. Is that oil prices are high because the demand for crude oil went down last year, but it's back to where it was, and it's going to grow. And so the places in the world where you can easily find large volumes to produce and come to market are places like Nigeria.
Yeah.
And so eventually we'll get there. Now, as it stands right now, if you look at the Western, we call the Western, or especially in North America, the financial markets have really got turned off by Africa, and as whether it's through ESG investors or what they perceive to be risk and foreign risk.
Yeah.
And so right now we have to balance. The United States, as I said earlier, is a jurisdiction that is risk-free. Like there's politics, whether you're a Republican or a Democrat, but you got elections, politicians come and go.
Yeah.
And in the long term, the United States is a pretty safe place to be.
Just very briefly, one final question. What are we going to be talking about in 2022 for COPL?
Well, what we're going to be talking about in 2022 is where our production plateaus, and we're on an incline curve. Right now I can't forecast easily where we're going to be next year. It's going to take us another couple of months until we see what we've got various models, but we're right at the crossover, close to the crossover point of seeing where we are.
Yeah. Okay.
The second thing is we've made an oil discovery down below the field, which we have 48,000 acres of leases all together in one big block. We've got all the lands tied up. And so, as time goes on next year, let's find out how actually big it is. We believe it's much bigger than what we have, substantially larger. And the second thing is we're also working on consolidating the working interests in the units that we have. Right now, we're the operator. We have 58%. And there's one of the parties has 27%, and we believe we're working on acquiring that. So by next year in 2022, hopefully we'll have the interest in the field consolidated. We certainly expect to be at much higher production rates, and we'll be at a better position to essentially appraise the size of this discovery we made. We've got more than one producing potential horizon that's got oil in it. So what we have to judge is, and this is why we're testing this well, which one to go after first. Okay, so it's a nice problem to have.
Indeed, that's right. Look, Arthur, we've got to leave it there, but thanks indeed for joining us. Arthur Millholland, Chief Executive and 3% owner of Canadian Overseas Petroleum. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.